economist Simon Kuznets found a 15 to 20-year pattern in infrastructure. Each cycle transforms economies. We're entering a new phase. You've seen the headlines about infrastructure bills and government spending plans, but there's something deeper happening beneath all the political noise. There's a rhythm to how societies build, a pattern that repeats across centuries and continents, and understanding this rhythm might be the most important thing you learn about the economy this decade. Because we're not just talking about roads and bridges, we're talking about a fundamental economic force that shapes everything from your job security to your retirement savings, from the value of your home to the trajectory of entire nations. Back in the 1930s, a Russian-born economist named Simon Kuznets was digging through mountains of data on American production and prices, trying to understand how economies actually move through time. What he discovered would eventually win him a Nobel Prize and reveal something that most people still don't understand today. Kuznets found that beneath the familiar boom and bust of regular business cycles, there was another pattern, slower and more powerful, running like a deep current through the economy. This pattern lasted 15 to 25 years on average, and it was driven by something surprisingly specific: the rhythm of building things, particularly infrastructure and housing. Kuznets connected these waves to demographic processes, especially immigrant population flows and changes in construction intensity. When he analysed long series of economic data stretching back to the 1860s, he kept seeing the same duration appearing again and again, around 20 years from peak to peak. This wasn't random noise in the data. This was a structural pulse in how modern economies develop. The mechanism he identified was elegant in its simplicity but profound in its implications. Demographic changes create rhythmic variations spanning approximately 2 decades. These demographic shifts, driven by fluctuations in birth rates, immigration levels, and changes in population age structure, create ripples through every layer of economic activity. When birth rates surge or immigration increases, it expands the working age population years later. That expansion increases both the supply of labour and the demand for housing and infrastructure to accommodate all those new households forming. During the upward phase of the cycle, elevated birth rates and immigration surges expand the working age population, increasing the supply of labour while simultaneously heightening demand for housing and infrastructure. Think about what happens when a wave of young people enters their 20s and 30s. They're not just workers, they're household formers. They need places to live. They're starting families, buying furniture, consuming services, creating demand across the entire economy. But here's the critical part that most people miss. Building infrastructure takes time. A lot of time. You can't just snap your fingers and create a new subdivision, a new highway, a new power grid. The very nature of construction means there's a lag between when demand starts rising and when new supply can actually come online. Let's walk through how this actually works in practice. Imagine it's the bottom of a cycle. The economy has been through a recession or a period of slow growth. Construction has been minimal for years because demand was weak and nobody wanted to take the risk of building when vacancy rates were high. But slowly, almost imperceptibly at first, things start to change. The population is still growing. People are still aging into household formation years. Immigration might be picking up. And all that existing housing stock and infrastructure that was overbuilt in the previous boom, it's being absorbed. Vacancy rates start to fall. Occupancy increases. And when occupancy rises above the long-term average, landlords can start raising rents. This is where the cycle starts to accelerate. Rising rents make new construction financially viable. Developers start planning projects. But remember, they can't build instantly. They need to secure financing, which takes months. They need permits, which can take years depending on the jurisdiction. They need to line up contractors, materials, labour. By the time they break ground, 18 months or 2 years might have passed since they first conceived the project, and then the actual construction takes another 2 to 5 years for the average development. So here's what happens during that long lag time. The economy has been expanding without the benefit of new supply for 5 to 7 years or more. During all of that time, occupancy rates have been climbing and rents have been rising. But then something crucial happens that Kuznets identified. The rent increases don't just go up steadily, they start accelerating. Rents aren't just higher than last year, they're rising faster than they were rising last year. This acceleration gets built into investors' forecasts and expectations. They start anticipating even higher rents in the future, And this is where the psychology of the cycle takes over from the mathematics. As one researcher documented as far back as 1935, there's a critical inflection point in real estate cycles where the price of land begins to reflect not the existing market conditions, but rather the anticipated rent growth to come. Speculation enters the picture. People who might have been cautious buyers a few years ago now see prices rising and worry about being priced out forever. Investors who are sitting on the sidelines see their competitors making money and jump in to avoid missing out. The financial system, seeing strong demand and rising values, loosens lending standards. Money flows more freely into construction and development. New completions from the mid-expansion phase finally start coming online in meaningful quantities, and this is where we hit what economists call the hypersupply phase. Construction is still financially viable because occupancy rates remain above the long-term average and rents are still rising. But now we see the first indicator of trouble. Vacancy starts increasing. Those projects that were started 5 or 6 years ago when occupancy was tight are now being completed into a market that's already tightening. The rate of rent growth starts decelerating. Rents are still going up, but they're not going up as fast as they were. They're no longer accelerating. This is the most precarious moment in the entire cycle, and it's where human psychology works against rational economic decision-making. A wise developer, seeing the change in direction of rent growth and understanding that there are still projects under construction that will deliver even more supply, should stop building, should pull back, should wait. But that's not what happens. Because from the developer's perspective, projects are still profitable. The current market still supports new construction, banks are still willing to lend, and there's enormous pressure not to be the one sitting on the sidelines when everyone else is still making money. So construction continues. In fact, it often accelerates because developers want to get their projects completed and sold before conditions deteriorate further, and this sets up the inevitable crash. The transition from hypersupply to recession comes when occupancy falls below the long-term average. New construction finally stops, but all those projects that were started during hypersupply continue to be delivered. Surplus inventory floods the market. Lower occupancy means lower revenues for landlords. Many property owners who bought at peak prices with lots of borrowed money find themselves underwater. Foreclosures follow. The real estate market crashes, and because construction is such a large part of the overall economy, the downturn in construction creates a broader recession. Economist Homer Hoyt studied the Chicago and broader United States real estate markets in detail and found something remarkable. The real estate cycle has run its course according to a steady 18-year rhythm since 1800. With just 2 exceptions, World War II and the mid-cycle peak created by the Federal Reserve's dramatic interest rate increases in 1979, the cycle has maintained its rhythm with almost clock-like regularity for more than 2 centuries. 18 years from peak to peak, with local variations of a year or two depending on specific market conditions. Now, let's zoom out from housing to look at the broader infrastructure cycle that Kuznets identified. Infrastructure investment follows the same basic pattern as housing, but with even longer lags and even more powerful economic effects. Roads, bridges, power grids, water systems, telecommunications networks, all of these require massive capital investment, long planning horizons, and even longer construction timelines than residential real estate. When you're talking about building a new transmission line, or replacing a bridge, or expanding a port, you're not looking at 2 to 5 year timelines. You're looking at 7 to 15-year timelines from initial planning to final completion. The data shows this clearly. Research analysing infrastructure investment across 50 countries and 7 sectors from now through 2040 reveals that global infrastructure investment needs to reach $94 trillion to keep pace with profound economic and demographic changes. That's not total infrastructure stock. That's new investment required over roughly 15 years. To put that in perspective, that's more than 3 times the size of current global economic output being spent on building and rebuilding the physical systems that make modern life possible. And here's what makes this particularly relevant for understanding where we are right now. The most recent data on United States infrastructure spending shows a dramatic shift happening. State and local capital investment, a major component of infrastructure spending, has grown as a share of state and local spending over the past 2 years by the largest amount since 1979. Even though infrastructure investment typically falls as a share of the economy at the beginning of economic recoveries, the United States has bucked that trend during this recovery. The bipartisan infrastructure law passed in 2021 directed $1.2 trillion of federal funds toward transportation, energy, and climate infrastructure projects. But here's the thing that most analysis misses. That federal spending is just the catalyst. It's the match that lights the fire. State and local governments respond to federal infrastructure investment by increasing their own capital spending. Between when the Infrastructure Investment and Jobs Act passed in 2021 and 2025, state and local spending on highways increased from $117 billion to over $130 billion. That's not counting the federal contribution. That's additional spending at the state and local level triggered by the federal program. Now let's connect this to the Kuznets cycle framework. If we're seeing a surge in infrastructure spending beginning around 2021 to 2023, and the typical Kuznets cycle runs 15 to 25 years, where does that put us? We're in the early expansion phase of an infrastructure supercycle. The projects being announced and funded today won't break ground for another year or two in many cases. The actual construction will run from 2025 or 2026 through 2030 to 2035. The economic impact of all that construction spending, all those jobs created, all that demand for materials and equipment and engineering services, that's going to be flowing through the economy for the next decade. And remember the mechanism Kuznets identified with demographics. The United States population is still growing. More importantly, the millennial generation, the largest generation in American history, is now entering their peak household formation years. People born between 1981 and 1996 are now between roughly 29 and 44 years old. This is precisely the age range when people buy homes, start families, move to suburbs, demand more infrastructure. The demographic wave that creates demand for infrastructure is cresting right now. But there's another layer to this that makes the current cycle potentially different in important ways. Previous infrastructure cycles were driven primarily by population growth and geographic expansion. The United States built the interstate highway system in the 1950s and 60s because the population was growing and spreading and needed better transportation networks. The massive build-out of telecommunications in the 1990s happened because digital technology was creating entirely new forms of demand. The infrastructure cycle we're entering now is driven by three simultaneous forces, each powerful enough on its own and combining to create something unprecedented. First, there's the traditional demographic demand from a large generation entering household formation years. Second, there's the need to replace aging infrastructure from previous building cycles. Much of America's core infrastructure dates from the 1950s, 60s and 70s. That infrastructure is now 50 to 70 years old, well past its design life in many cases. The American Society of Civil Engineers gives United States infrastructure an overall grade of C, estimating that $9.1 trillion in investments are needed over the next decade just to improve, modernize, and maintain critical systems. Third, and perhaps most importantly, there's the energy transition and digitalization creating entirely new categories of infrastructure demand. Data centers require enormous amounts of electricity. The International Energy Agency projects that global electricity demand from data centers will double under the base case scenario and triple in the upside scenario by 2030. Electric vehicles need charging infrastructure. Renewable energy requires new transmission lines to connect wind and solar farms to population centers. The Department of Energy estimates that transmission systems will need to expand 60% by 2030 just to support power capacity growth and the transition toward more renewables. McKinsey projects that $106 trillion in infrastructure investment will be needed between now and 2040. Asia will account for $70 trillion of that, the Americas $16 trillion, Europe $13 trillion. On a sectoral level, transportation leads with $36 trillion expected to be invested in roads, ports, airports, railways. Power and utilities will see $24 trillion. Digital infrastructure, fiber networks, telecommunications, data centers, satellites will attract $19 trillion. These aren't abstract numbers. These are projects that need to be planned, financed, designed, permitted, constructed. Every one of those dollars represents economic activity. Jobs for engineers, construction workers, equipment operators, demand for steel, concrete, copper, fiber optic cable. revenue for construction companies, equipment manufacturers, material suppliers, and all of that economic activity creates multiplier effects throughout the economy. Infrastructure workers spend their wages on consumer goods and services. Material suppliers hire more workers to meet demand. Equipment manufacturers invest in expanding capacity. But here's where understanding the Kuznets cycle framework becomes essential for investors, workers, policymakers, anyone trying to navigate the next 15 years. Because cycles don't just have upswings, they have patterns, they have rhythms. And those rhythms create opportunities and risks that most people won't see coming because they don't understand the underlying structure. Historical research on infrastructure spending cycles reveals a concerning pattern that investors need to understand. Companies aggressively growing their balance sheets have underperformed conservative peers by 8.4% annually from 1963 to 2025. This asset growth anomaly held true across multiple sectors and time periods. Firms rapidly increasing capital expenditures showed similar underperformance, with the effect accelerating during the dot-com bust but remaining consistent even outside bubble periods. Current infrastructure spending, particularly in areas like artificial intelligence and data centers, already exceeds the internet boom's peak relative to gross domestic product. When adjusted for the shorter useful life of AI chips versus physical infrastructure, this spending surpasses even the railroad build-out of the 1860s and 70s. Big tech firms are on track to spend nearly $400 billion in 2025 alone on AI infrastructure. That represents about half of United States GDP growth coming from just one category of capital spending. This creates a fascinating parallel to previous infrastructure cycles. The winners of past infrastructure booms were often not those who built the infrastructure, but those who used it wisely. The railroad companies that built tracks across America in the 19th century mostly went bankrupt or delivered poor returns to shareholders. The companies that thrived were those that used the railroads to expand their markets and reduce transportation costs. The telecommunications companies that built out fiber networks in the late 1990s often failed or were acquired at distressed prices. The companies that prospered were those like Amazon and Google that used that infrastructure to build entirely new business models. So if we're in the early stages of a major infrastructure build-out cycle running from roughly 2025 through 2040, what does that mean for different participants in the economy? For construction workers and civil engineers, it likely means strong demand for the next decade or longer. Infrastructure projects require specialized skills, and there's already a shortage of qualified workers in many trades. For material suppliers, particularly in steel, concrete, copper, and rare earth elements needed for clean energy technology, it means sustained demand but also the risk of overcapacity if too many producers expand at the same time. For investors, it means understanding that infrastructure stocks and construction companies might not be the best way to capture the cycle's benefits. Historical patterns suggest that early adopters who benefit from new infrastructure, companies that can use improved roads, better power grids, faster telecommunications to enhance their operations, often outperform the infrastructure builders themselves. For policymakers, it means recognizing that the decisions made today about permitting, regulation, and infrastructure priorities will shape economic geography and competitive advantage for decades. For workers in sectors that might seem disconnected from infrastructure, it means understanding that infrastructure cycles affect wage growth and job security across the entire economy. When construction is booming, it pulls workers from other sectors, creating labor shortages that drive up wages. When infrastructure spending crashes, those workers flood back into other sectors, creating excess supply that suppresses wage growth. And here's something that doesn't get discussed enough. Infrastructure cycles create regional winners and losers in ways that most people don't anticipate. The bipartisan infrastructure law data shows that lower income states have tended to receive more funding per capita than higher income states. States with the lowest rated infrastructure are getting more funding per capita than states with the highest rated infrastructure. This isn't accidental. It reflects both political considerations and genuine need. But it also means that the economic benefits of the infrastructure cycle will be geographically concentrated in ways that shift economic opportunity. Historically, states with higher median household incomes invested more in infrastructure, creating a reinforcing cycle where wealthy states became wealthier because they had better infrastructure. The current infrastructure cycle has the potential to reverse that pattern directing investment toward regions that have been falling behind, potentially reshaping regional comparative advantage for the first time in generations. Now, let's talk about timing, because understanding when things happen is just as important as understanding what happens. The Kuznets cycle framework suggests we're in approximately year 3 or 4 of a 15 to 20-year expansion phase. Infrastructure spending began ramping up in 2021 and 2022 with the passage of major federal legislation. Most of that money is flowing through state and local governments, who are now in the planning and early construction phases of thousands of projects. The peak of this cycle, if historical patterns hold, would come somewhere between 2033 and 2038, roughly 15 to 18 years after the initial surge in spending began. That's when construction activity would reach its maximum, when the most workers are employed in infrastructure, when the most concrete and steel and copper are being consumed, when the economic multipliers are at their strongest. And that's also when the seeds of the next downturn would be planted, as overbuilding and excess capacity start to emerge in some sectors. But unlike housing cycles, which can turn quite sharply, infrastructure cycles tend to have longer, slower transitions between phases. You don't suddenly have massive overcapacity in highways or power grids the way you can in housing. Infrastructure demand is driven by long-term demographic and economic trends that don't reverse quickly. So the hypersupply phase, the period when construction continues even as early signs of excess capacity emerge, tends to be more drawn out in infrastructure than in housing. This suggests that from 2025 through 2040, the dominant economic story in developed economies will be infrastructure build-out. Not every year will be positive. There will be setbacks, financing challenges, political obstacles, but the underlying demographic and technological forces driving infrastructure demand are powerful and persistent. The millennial generation will be moving through their peak earning and consuming years. Urbanization will continue globally, with the urban population growing 46% by 2040, triggering massive demand for infrastructure support. The clean energy transition will require rebuilding substantial portions of the power generation and transmission infrastructure. The digital economy will demand exponential increases in computing power and data transmission capacity. These aren't short-term trends that might reverse. These are structural shifts that will unfold over decades, and here's where the Kuznets cycle framework provides real insight for individuals trying to make decisions about their lives and careers. If you're in your 20s or early 30s today, you're entering the job market at the beginning of a major infrastructure cycle. Skills in engineering, project management, construction, skilled trades, all of these will likely be in high demand for the next 10 to 15 years, if you're thinking about where to live. Regions that are attracting major infrastructure investment might offer better economic opportunities than traditional coastal hubs that already have mature infrastructure. If you're managing a business, understanding that infrastructure cycles create both opportunities and constraints is essential. Opportunities because better infrastructure reduces costs and expands markets. Constraints because infrastructure build-outs create competition for labor and materials that can drive up input costs. If you're thinking about investments, recognizing that infrastructure cycles create multi-year trends that persist, despite short-term volatility, can help you avoid getting shaken out of positions by temporary setbacks. But perhaps most importantly, understanding the Kuznets cycle helps you recognize that what looks like chaos and randomness in the economy often has underlying structure and pattern. The boom-bust cycle in construction isn't random. It's a predictable consequence of the lag between when demand starts rising and when new supply can come online, combined with human psychology that tends toward overbuilding during good times and excessive caution during bad times. The infrastructure needs that seem overwhelming when stated as single large numbers, 94 trillion globally, 9 trillion in the United States, these aren't insurmountable problems. They're actually normal requirements of a growing economy with an aging population and evolving technology. Spread over 15 to 20 years, 94 trillion globally is roughly 6 trillion per year, about 6% of global GDP. That's high by recent standards, but not unprecedented historically. The United States spent comparable shares of GDP on infrastructure during previous build-out cycles in the 1950s and 60s. What makes it challenging isn't the total amount, but the coordination problem. Infrastructure requires planning across multiple levels of government, coordination between public and private sectors, long-term financing, political will that persists across electoral cycles. These are difficult but solvable problems, and societies have solved them repeatedly throughout history when the need became pressing enough. We're at a moment when the need has become pressing. Crumbling infrastructure that was built 50 to 70 years ago, demographic demand from a large generation entering household formation years, technological transformation requiring entirely new categories of infrastructure, climate risks demanding resilient systems that can withstand extreme weather, energy transition requiring massive build-outs of generation and transmission, digital transformation requiring exponential increases in computing and connectivity. All of these forces are converging right now, and they're converging in ways that create what Kuznets identified as a long swing in economic activity. This isn't a business cycle that will play out over 3 to 5 years. This is a structural cycle that will define economic opportunity and growth for the next 15 to 20 years. Understanding that, recognizing the patterns, seeing where we are in the cycle, that's how you position yourself to benefit rather than getting caught unprepared when the cycle inevitably turns, because cycles always turn. The expansion phase we're entering will eventually transition to hypersupply as all those projects being planned today get built and completed. Hypersupply will transition to recession when overbuilding and rising interest rates make new projects uneconomical. Recession will bottom out and transition to recovery as excess inventory gets absorbed and demographic demand rebuilds. And recovery will transition to a new expansion as construction ramps up again to meet renewed demand. This pattern has repeated for 200 years. It repeated through wars and depressions and technological revolutions. It repeated through the Industrial Revolution and the Railroad era and the Automobile Age and the digital transformation. And it's repeating again now in the infrastructure demands of the 21st century. The details change, the specific technologies change, the geographic focus shifts, but the underlying rhythm, the 15 to 25-year pulse of building and overbuilding and correction that Kuznets identified, that rhythm persists. If you understand that rhythm, if you can see the pattern beneath the noise, you have an enormous advantage over people who think the economy just randomly lurches from boom to bust for mysterious reasons. You can see opportunities coming years in advance. You can see risks building before they become obvious to everyone else. You can make decisions about education, career, location, investment, business strategy with a time horizon that matches the actual structure of how economies develop rather than just reacting to whatever happened last quarter. And that's ultimately what understanding the Kuznets cycle gives you. Not a crystal ball that predicts the future with certainty, because there's always uncertainty and always unexpected events, but a framework for understanding the deeper currents that shape economic activity over timeframes longer than business cycles but shorter than centuries. A way to see the forest instead of just the trees. A recognition that while the details are always changing, the patterns repeat, and those patterns create opportunities for people who understand them. We're entering a new phase of this ancient pattern right now. The infrastructure cycle that will define the next 15 to 20 years is just beginning. The projects being announced today will reshape cities and regions. The jobs being created will support families and communities. The technologies being deployed will change how we work and live. And all of it will unfold according to rhythms that Simon Kuznets first identified nearly a century ago, rhythms that persist because they're rooted in fundamental features of how humans build societies and how economies grow. So pay attention to infrastructure spending in your region. Watch which projects are being funded and where construction is actually beginning. Notice which industries are hiring and which skills are in demand, because those patterns will tell you where the opportunities are in this cycle. And understanding the cycle means understanding that those opportunities will last years, not months, giving you time to position yourself to benefit from trends that most people won't recognize until they're already well established. If you found this analysis helpful, if you want to understand the deeper patterns that shape economic opportunity rather than just reacting to headlines, make sure you subscribe. Because the infrastructure cycle is just one pattern among many. There are demographic cycles, debt cycles, technological cycles, all running simultaneously at different speeds, all creating opportunities and risks for people who understand them, and that understanding, that ability to see patterns that most people miss, that might be the most valuable skill you can develop in a world where change keeps accelerating, but the underlying structures keep repeating in new forms.